What's going on, guys? Happy Friday. Welcome back to another Dividend Happy Hour. I know we're a few minutes early tonight. Kind of like last week, I just got set up pretty early. And I figured, why not? Why not go live just a little bit earlier tonight? We're about 5 minutes early. Another part of the reason I just decided to start the stream is because right after this, my wife and I are going to go get a workout in. And I'm going to, because of that, I'm probably going to wrap this up by like 5:45-ish. So we've got about 50 minutes from now. So that's another reason why I wanted to start a little bit early, just to get as much time with you guys tonight as I can. But hope everyone had a great week. Pretty uneventful day. The market was closed today, which is always kind of a bittersweet thing. It just feels so, I don't know. I don't want to say boring, but it definitely feels like something's missing on these weekdays where the stock market's closed. I don't know if you guys feel the same way, but at the same time, it's nice to have a little reprieve. It's nice to have a little bit of a break. So I think it's probably needed, but I don't know about you guys. Finish the week strong. Kind of rambling at this point. Let's see, guys. Why don't we just get into it? Kick this thing off the best way we know how, with a quick cheers. So grab whatever it is you're sipping on. I've got a little cup of Joe here, which I know is a little bit odd, but I want a little pick me up going into tonight's workout, because I don't usually work out this late, excuse me. So anyway, cheers. Here's to you guys. Thanks so much for tuning in with me tonight and hanging out for another Dividend Happy Hour. And also here's to those dividends. Here's to the pursuit of that sweet, sweet cash flow, which really at the end of the day is what's bringing us all together. But nonetheless, I appreciate you guys. Cheers. Ooh, that is so nice. And you guys can't see him, but I've got my co-host right over here. He's over here for the time being. And I don't know, guys, so with Peanut, I'm talking about my cat. There are days where I feel like I don't see him the entire day. He's like off doing his own thing. He's sleeping under the couch. He's got like a little, like carrier house thing down here that he likes to lay in. And there are some days where I don't see him for the entire day. And then there's other days like today where he will not freaking leave me alone. He's like my shadow. He's rubbing up against my leg all day. And it's been one of those days where it's like, oh my gosh, every time I turn around, he's like there. I can't even walk without almost stepping on him. But, and he's by my side right here too as well. But he's being a good boy. He's, looks like he's going down for his probably fourth or fifth nap of the day. But my friends, I want to hear a couple of things. Getting back on track, I want to hear a couple of things from you guys here in the chat. Number one, I know we had a short week on the market, but I want to know what you picked up this week. Which stocks did you add to your portfolio? I'm curious to know. If you guys saw my video from Wednesday, I actually started a new position in the portfolio, which I'm not quite ready to reveal yet. I'm going to be making a video revealing it sometime next week, I think. So yeah, stay tuned for that. That's going to be a good video. It's going to be a very different video, but I want to hear what you guys picked up this week. Number one. Number two, I want to know what you're sipping on tonight here in the Dividend Happy Hour. What did you bring to drink here? Number three, I want to know if anything cool happened in your guys' portfolio this week. Maybe you hit a new dividend income milestone. Maybe you finally got that 100th share of SCHD. Maybe you are now bringing in $50 every month from Realty Income. I'm coming up with random things, but let me know if anything cool happened in your guys' portfolio this week. I want to hear about that as well. And also number four, I want to know if we have any first timers here in the Dividend Happy Hour. Let me know in the chat if this is your first time tuning into the live stream. In case it is, welcome aboard. So stoked to see you in here. And just so you know, we typically do this live stream every week, every Friday night, starting at 5 p.m. Pacific time, 8 p.m. Eastern time. And it's always a fun time just to, come and hang out and talk stocks with all of you guys, my favorite people out there. But let me know all those things in the chat, and let me scroll up here just a little bit and see what you guys have to say. Just shout out to everyone here in the chat. It looks like we've got about 112 of us. And I know more people are going to pour in because now we're at the top of the hour, which is normally when this stream starts. And once again, I apologize for those of you who are just now jumping in a few minutes into the stream. I did kick things off a little bit early, but you really didn't miss anything. Didn't miss anything. And also, guys, drop your drop any investing questions you guys have. Drop those in the chat as well, and we'll go through them after we get through some of these. Just get caught up in the chat, basically. Okay, so Chris, you did end up selling out of Amazon. Okay, but you rebought it at a cheaper cost. Interesting. Nathan wants to know if I ever sell covered calls. I do not, my friend. I do not. Let's see. Guys. See a lot of the usual suspects in here. What's going on, guys? Ooh, Eduardo, thoughts on UnitedHealth? Here, we'll save that one. Circle back to it because we'll take a look at UnitedHealth. Yesterday, they had a pretty crazy drop. I think they just, if I remember correctly, I think they just reported some earnings, some subpar earnings, I should say. Let's see. As far as pickups, I see some SCHD. I see a lot of realty income here. Yeah, it looks like Wyatt started a position in Amazon. Nathan wants to know my thoughts on selling covered calls. We'll see. We'll circle back to that. Let's see. Yeah, it looks like there's a few of you first timers. Nathan's first time, Eduardo's first time, Dominique's first time. Welcome, guys. Welcome. Let's see. Yeah, Jack Mack. Glad to catch you live. Glad to see you in the chat, my friend. Hope you're doing well. Let's see. There we go. Lean Mean Dean Machine hit $3,000 per year in dividend income. Man, that's incredible. Good job. 3K. That's a big one. That's oh no, I'm trying to get to 3,600. I just was going to look at my spreadsheet and think, am I at 3K yet? Let's see. Dylan, you're a dog. What's your full-time job? This is my full-time job. Believe it or not, this YouTube stuff and writing my newsletter and everything that goes along with it, this has been my full-time gig for the last 2.5 years or so. And I wouldn't have it any other way. I absolutely love doing this. And I feel so fortunate that I get to do this. And I hope that I get to do it for the rest of my life. That's my plan if you guys will have me. Let's see. Okay. So Janet wants to know about tickers like FTQI. There we go. Ken picked up his 100th share of realty income. That's awesome. Let's see. Ooh, martini time for Mark. Nice. Fast Eddie, how's the wife's portfolio doing? It's doing okay. I mean, it's just the S&P and SCHD. She's got about $400 in birthday money that I need to go and deploy for her. I need to do that. I need to remember to do that next week. So I'll try and do that Monday, but it's going well. You don't have a join channel membership. No, I'll circle back to this because that's something I've been thinking about. Nice. Okay, cool. So it looks like we are caught up here in the chat. Mr. Swack, first time live. Welcome. Welcome, my friend. So let's see, guys. I've got about, looks like 4 comments saved here so far. So we'll go through some of these. So, okay. Eduardo wants to know thoughts on UNH, thoughts on UnitedHealth Group. So let's actually jump over to the screen. First and foremost, let's check out what's going on with UNH, see if maybe we can get some background on why the stock dropped so much in share price. From what I remember, like I was saying, it had something to do with earnings. So here we, plunges 23%. Is there something else that, okay, so I want to look at this. I want to look at this right here. So first and foremost, if this loads, slumps drag peers after guidance cut. So that's what it is. The stock fell 20% in pre-market on Thursday after the company slashes full year profit outlook following lower than expected Q1 Financials. Okay, so lower than expected guidance moving forward, or reduced guidance, but still, I don't know what the earnings per share was this time last year, but because I truthfully don't really keep close tabs on UnitedHealth Group. A lot of the insurance companies, or pretty much all the insurance companies, are stocks that it's just not really in my wheelhouse. So I don't keep close tabs on a lot of these stocks. Ari has a big position in UNH. I know this is one of his biggest positions, so he's probably pretty stoked to see this share price drop. And it looks like yesterday it ended up finishing down over 22%. But still looking at this, I mean, revenue is still up about 10% year over year. Let's see if we can look and see if we can see what the earnings per share was this time last year. So 720, missed by 9 cents. So let's go back over here to earnings. 720. This would have been Q1 2024 is what we're looking for. Okay, so, earnings was up quite a bit. Okay, here we go. So it was up 10% compared to, oh, that's revenue, excuse me. Okay, so earnings this quarter was $7.20. This time last year, it was $6.91. So it's up 30 cents year over year. What is that? That's less than a 5% increase year over year. But still, both numbers are up. Revenue's up 10%. Earnings per share is also up year over year. So pretty big drop based on that. So it's still growing, which is good. But the drop, or the growth, not as much as expected. And they also cut the guidance, which is what sent the share price plummeting down. And maybe it's justified. Who knows? Because prior to let me actually take a step back. Going into the year, the stock was about $485 per share. Then it soared from, February 21st, soared all the way up to $600 per share. So it saw a rapid rise. It saw a very aggressive rise very rapidly, is what I'm trying to say. So it seems like the share price, it was really pushed up there. So any bit of negative news was going to send it plummeting down. It was probably just very sensitive. Just because of the rapid rise in share price. So maybe it's not all too surprising to see this big drop. But man, that's crazy to see though. Down $131 per share just in a single day. That is undeniably a big drop. So the yield, let's see the yield here. So 1.85%. Right now, the yield is still about 30% above the company's 5-year average. So that's looking pretty good. Nice and high free cash flow yield at 7.6%. So, may not be a bad time to swoop up some shares of Peanut. Swoop up some shares of UnitedHealth Group right now based on this drop. But, like I said, beyond that, I really don't have any serious opinions about this company. And that the same is true for any insurance company out there. I'm just not really too familiar with them and how to look at them. So, that's kind of where I'll leave it. Let's see what else before we move on. What else do we got here in the chat? Okay. Let's see. Okay, Korean Cardboard's got a good question here. Okay. Okay, so Nathan here says, what are your thoughts on selling covered calls? So selling covered calls is not something that I personally do. I don't have an interest in doing it. To me, it adds an element of risk and timing that I'm not particularly interested in taking on at the moment. That may change down the road, but it's a bit more active than I would like to be in my portfolio, which is funny to say because, I have one portfolio filled with just individual stocks that I actively manage. So there's that. But on top of that, I just don't really have much of an interest in doing more than I'm already doing, I guess is what I'm trying to say. But on the other hand, on the other side of that, I do know that selling covered calls is a great way to generate extra income. I know a lot of other investors who do it and do it successfully. and it definitely gives them a nice boost in income. I got to shout out my man Wayne. I don't think he's watching. Maybe he'll watch the replay, but my man Wayne Nichols, check him out on YouTube, guys, too. He's got a great channel, and he just crushes it with options. It's pretty crazy to me how much he's generating in options income every single month and every single year. It's like a it's like a full-time salary just trading options for him. So which is very impressive. So I will say, just because of that and because of seeing the potential of it, it is pretty tempting. But overall, it's, like I said, it's just not something I'm particularly interested in doing. And I don't really have much of an aversion to, I don't really have much against some of the covered call ETFs out there. Like if you didn't want to do it yourself, or like in my case, and saying everything I just said, it kind of begs the question, okay, well, you don't want to do it yourself. Why don't you just like invest in a covered call ETF or something like that? Why don't you just throw money into like a JEPI or a JEPQ? And it's like, yeah, that's probably a good question to ask. And I used to have JEPI back in the day, but I came to a similar conclusion. I would just rather own individual companies whose income and whose long-term performance is driven by the performance of the underlying business and the growth of the business, rather than on like derivatives. And that's what options are. And it's just not a financial product that I'd like to get into it, to be into at this point. And I also think when it comes to the covered call ETFs, there's just a lot of junk ones out there. And yeah, so I don't know. I think I'm better off just staying away from them completely. And I know that was a very long-winded, roundabout way to answer that question, but hopefully hopefully it did the job for you. Let's see. Yeah, Trevon says, look at Snap-on. We can definitely do that. Ooh, Shane's got a really good question too. Let's see. Yeah, Helm wants to know about Snap-on as well. So we'll take a look at Snap-on. Yeah, JJ says, I don't think it'd be as time consuming as you think if you just have one or two open at a time and set the expiration date a couple weeks or more out. Maybe like it's not going to take a lot of time to push the buttons, but for me to learn options to the point where I feel comfortable doing them for myself, that will take time. The amount of time I will spend thinking about my options trades will certainly be consuming for me. And all of the extracurricular stuff like that goes along with it, I'm just not ready to take on. It's more than just pushing buttons, it's more than just pushing the buttons to actually sell the calls or the puts or whatever. It's the headspace involved with it. It's the time to learn, the time to think about it. And I just don't want to do it. So let's see, let's keep going. So this next question is from Janet. Said, I've been waiting for this live stream. Nice. Nothing new or exciting. Nothing exciting or new with me sipping on water. Question for the dividend master. I don't know about that, but I will take it. Thanks, Janet. Can you explain tickers like FTQI? Sounds like something that I just on the surface, I don't want to judge a book by its cover just yet, but it already sounds like something I will not be interested in. Okay, so let's take a look at it. Let's jump over to the screen. I've got FTQI pulled up here on Seeking Alpha. And as we can see, this is the first trust NASDAQ buy right income ETF. And let me just say this, like another reason that I don't want to invest in covered call ETFs or put money into covered call ETFs is because, man, they are a dime a dozen at this point. Every single day, there's a new covered call ETF or a new options ETF or income ETF or something that uses derivatives such as options. There's a new one out every single day, and I just can't keep up. I just can't keep up. So when it comes to explaining tickers like FTQI, truth be told, I don't know that I can explain it any better than this fun profile here does. But let's take a look. Invest directly and through derivatives in stocks across different sectors. Okay, so trades options, invest in growth and value stocks of companies benchmark the performance of the SIBO NASDAQ 100 buy right index, S&P, and the NASDAQ. Okay, it's only been around. Okay, it's been around for 10 years. That's actually good. 11 years to provide current income. So I do like to see that. I do like that this fund has been around for an extended period of time. Selling call options on the NASDAQ 100. Okay. Expirations of less than a year and are at the money to out of the money. So first and foremost, so it sounds like just a pretty standard covered call ETF. And the top 10 holdings are pretty solid. I have nothing bad to say about these. Looks pretty similar for the most part to like something you'd find with just like the S&P 500 or something along those lines. How many total? So there's 187 different holdings. Dividends here. Yeah, interesting. 13.5% yield, 30% growth rate. Very nice. Big jump in income right here. Wow. Holy cow. Wonder what happened there. Monthly. Okay, so it's always been monthly. Interesting. Okay, let's look at, let's compare it to JEPI, JEPQ, and then also the S&P 500 there. And then let's go total return here. So let's go a longer period of time. So it's been around for 10 years, so we can go back that far. Okay, so it looks like, and it's hard to compare it to JEPI, like in this longer, or JEPQ in this longer time period, because JEPQ's only been around for about 3 years. But compared to JEPI, it looks like JEPI's outperforming FTQI, and it looks like the S&P is also outperforming FTQI. On the 10-year, even though this has been around for the full 10 years and JEPI's only been around for about half of that, JEPI's still seeing a higher total return in half the time than FTQI has seen over the last 10 years. And it's seeing about a third of the returns of the S&P 500. So, but it's different goals, I would say. I mean, if your ultimate goal is total returns, undeniably you should invest in this. You know, if it's income you're going for, then maybe okay. But I still think JEPI takes the cake here. I still think if you're going to go between this and something like a JEPI or a JEPQ, seems to me that JEPI and JEPQ have the edge here. So I would be more partial to those. But this isn't as bad as I was expecting. With that said, too, the expense ratio is a bit higher than what you'd find with a JEPI or a JEPQ, 0.75% compared to 0.35%, so less than half. But yeah, interesting one. Very interesting. I've seen worse. I will say that. Let's see. See. What did I miss here in the chat? Ooh. Almost out of coffee. I only had about half a cup of Joe. I didn't have much left in the pot. Let's see. Okay. Oh, thank you guys. I'm seeing some nice comments here in the chat. I really appreciate it. Really, really appreciate it. And on that note, I sincerely appreciate all of you guys. I can't even. So we're episode 134 into this live stream series. I can't even believe that many people tune into this every single week. It still blows my mind. And I know I say this all the time. I think I said it last week, but I have the most fun doing this every week with you guys. I have more fun doing, I shouldn't say more fun, but this is the thing that when it comes to, okay, come on, Ryan, reset. Out of all of the content that I make, out of all the videos I do, everything that I do on this YouTube channel, this is the thing that I look forward to most every week. I love doing this live stream with you guys. Okay, so I've got a couple of you guys asking about Disney here too, so we'll take a look at that. Take a look at that. Okay, but so that was a good question from Janet. This one from Eduardo. You don't have a join channel membership. Yeah, that's right. I don't have any channel membership set up. Truth be told, like, and I'm not opposed to it. It would hopefully be another good revenue stream for the channel. But truth be told, I just don't know what I would offer behind the scenes. I don't know what I would offer in a membership. Maybe extra videos, maybe an extra live stream series. That's the only thing I could come up with, like, as an extra weekly live stream series. But and maybe I'll do that at some point. Maybe I'll consider like doing that at some point this year even, but at this point in time, I just don't want to add anything more to my plate right now. Kind of got a lot on the plate. And so I'm just not looking to add anything additional, even if it were to bring in some extra revenue. So maybe in the future though, we'll see what happens. We'll see what happens. Okay, but Sam here says, what strategy do you think is better, maxing out a Roth IRA at the beginning of the year or dollar cost averaging throughout the year? So that's a good question. I don't know. I don't think you can go wrong either way. Different people here are going to have different approaches. Personally speaking, I dollar cost average into my Roth IRA throughout the year. Every single week I invest a set amount. And the main reason that I do so is just to have that consistent process, I suppose. For me, it helps me stay disciplined and dedicated doing it on that regular of a basis. And the same is true in my taxable account. I invest in there every single week as well. So I like having that level of activity every week. And it can also, like, just from a performance standpoint, it from a long-term perspective, it's probably not going to make much of a difference. But it can probably slightly, depending on what the market does on any given year. Like, for example, if you just did a lump sum investment into your Roth IRA, maxed it out January 1st every single year. Well, let's just start with 1 year, not every single year. But let's say you're lump summing into your Roth IRA. And that year, you do it on January 1st, and then that year the market goes up, 20% or whatever it is. It goes up. You're going to be glad that you invested that money right up front before the market went up. That way you wouldn't have had to, along the way, buy stocks as they were going up in value, which, as they go up in value, you're not getting as much bang for your buck. So you'll have been glad to have bought more when the share price was cheaper. Hopefully that makes sense so far. But then again, on the other hand, there's another side to that. Let's say you do the same thing. You lump sum it on January 1st, but that year the market tanks. You won't be so happy to have bought, put in so much money and bought all these shares of VU or SCHD or whatever it is at the start of the year when they were more expensive. You would have looked at that and said, shoot, I should have dollar cost averaged, or I should have waited. I should have waited to buy things when they were cheaper, or something like that. You'll play that mind game with yourself. So it partly depends, like, just what the market does, whichever is better, really, from a performance standpoint. And that just applies to that year. I'm sure if you did it for a longer period of time, where you'll experience years where the market's up and years where the market's down, it's probably not going to make too much of a difference in the long run. I don't know that. I'm just kind of thinking out loud. But that would be my guess. And I think ultimately, to close the book on this question, to give it a solid answer, what would be I'm actually going to screenshot this, because this could be a good question to answer in the future. So to close the book on this, the strategy that's going to be better is the one that you can better adhere to. For me, personally speaking, it's easier to dollar cost average every week because it's a lower amount of cash. I can swing, $130, $135 every single week. Typically, it's going to be easier for me to do that than it is going to be to just lump sum invest $7,500 at the start of every single year. You could be disciplined and set aside that cash in preparation for that every year. But maybe you're not so disciplined. Maybe it's easier for you just to consistently tuck those smaller amounts away every single week. I know for me that's the case, and that's the primary reason that I do it that way. Because you never know. There could be some years where you maybe have good intentions in setting aside that cash to lump sum it at the turn of the year, but maybe something happens or you just something happens to where you end up dipping into that cash. You're not able to save as much as you think, and then you're kind of missing out on contributions that you could have made. So, and maybe because of that, it's harder for you to adhere to that annual lump sum investment. No right answer, I guess, is really what it boils down to, and hopefully all of that makes sense. There's different ways to look at it for sure. But I mean, with that said, what do you guys do? Do you guys dollar cost average? Do you guys lump sum at the start of the year? I want to know. Let me know in the chat, and I'd be curious to see what the consensus is amongst you guys before we move on. And real quick, got to shout out my man Nick. What's up, man? Happy to see you in the live stream. I hope you're doing well. Let's see. But let's keep going. So Fast Eddie says lump sum is going to help lump sum is going to help outperform dollar cost average 66% versus 33%. So are you saying that 66% of the time lump sum is going to outperform dollar cost averaging? And I'd be curious to know where that number comes from and what the reasoning is behind that. Yeah, then here's Adon says, I like to max it out at the beginning of the year just so I have it taken care of. Just so it's out, just so you don't have to think about it the rest of the year. Okay. Then JJ says, well, maybe break it in half lump sum on January 1st, and then dollar cost average the other half. That would be a good happy medium. That could be a good way to go. Let's see. Sir Dude Broman says, I would say dollar cost averaging into a Roth and lump summing are not too different. I can speak to doing it both ways because I'm currently maxing it out at the beginning of the year. Okay. Gabe says, dude, I did exactly that this year. I lump sum my Roth IRA about January 15th. I bought Meta for like $650. Now look at it's way down. Oh, this is so awesome. Kason says, I'm 60 and a half years old, and this is my first ever stream that I've tuned into other than my son's channel, and I've picked up so many things. I picked up many things. So thank you from somebody who is about 8 years away from retirement. Man, sincerely reading this makes my day. Thank you so much for tuning into the stream. And I'm glad that you've found my gibberish and stuttering helpful. At least someone does. At least someone does. I'm happy to hear that. There we go. So Bubble Chaser's got the good balance. Says, this year I lumped sum $3,500 cost average throughout the rest of the year. Yeah, when in doubt, why not do both? That's seems to be a good way to go that gives you the best of both worlds, no matter what's happening in the market. Yeah, so Adam here says, I put cash into 3-month CDs to make sure I keep the cash in cash until I see what I'm looking for. So that's good. So that's another thing you could do. You can set aside your Roth contributions into a CD. That way it's locked away in there for a period of time so you can't touch it. That's a good move. That can help you stay disciplined. We got Nick says, I do $600 a month to the Roth. Yeah, that's about, so you're doing it on a monthly basis. That's more or less about what I do, except it's weekly. So I think at this point I'm $130 per week, $130 per week into the Roth. And then whatever else I have to close the gap at the end of the year, I just lump sum the rest of it. But it's only like a couple $100 or a few hundred bucks when it's all said and done. Let's see. Okay, so Mark lump sums every year. Yeah, Jonah lumps sum in Roth as much as I can, then dollar cost average into taxable. Okay. Chris, dollar cost average every 2 weeks, and then every week into taxable. Okay. Okay, so it seems like a lot of you guys do the lump sum. Actually, it's pretty even. It looks like it's a pretty even split because then we've got Dean and Janice, both dollar cost average. Sir Dude Bromance kind of in the middle. Yeah, Janice, 206 in the live stream tonight. Yes, I love it. I love when we get over 200. Thank you guys again for tuning in and hanging out. This is fun. Ooh, Alan, man, this is good question. How do you think the market will open on Monday? I don't know, man. I just don't know. Maybe some red. Maybe some red. You know, we finished the week very strong. Thursday was a very, very strong day in the market. So I could see it kind of boomeranging back a little bit on Monday. We'll see what happens, though. Could go either way. Let's see. All right, guys, let's jump back over here. So I've got 4 more questions saved. This next one's from Korean Cardboard. I have Ares Capital and Blue Owl Capital Corporation, which are both business development companies. But what are your thoughts on doing BDC ETFs like PBDC and BizD? So, you know, I'm for it. I don't think that's a bad way to go if you wanted exposure to some business development companies, but weren't sure which ones to pick. I think getting exposure to them through an ETF like that is totally fine. On a similar semi-related note, I feel the same way about the MLP ETFs. I don't remember the tickers off the top of my head, but I know that there's one master limited partnership ETF. Russ has it. Like I said, I don't remember the ticker, but I think same thing. If you were looking for exposure to master limited partnerships, but weren't sure which one to buy, and also didn't want to deal with the Schedule K ones, which I know a lot of people don't, then I think getting into an MLP ETF would be a fine way to go. So yeah, I think that's just fine. But just like any other ETF, go with the one that's going to be as low cost as possible while still generating, you know, the highest returns possible. It's kind of what you want to look for. All right. Let's see. Trader, you picking up any Ford? No Ford for me. My dad actually just earlier this week, he was telling me he picked up some Ford. He bought a lot of Ford, and he said he bought a lot of Boeing. And Adam, I think you're pretty hot on Boeing too, right? If I remember correctly. But yeah, neither of those for me. Neither of those for me. Yes, Korean Cardboard, MLPX, that is the one. This is the MLP ETF. So yeah, not a bad way to go. Gilbert's got a good question. I actually touched on it earlier in the stream, but I'll circle back to it again. Silverton wants to know about Main Street Capital Corporation. Okay, so guys, let's keep going. Trevon, can you look at Snap-on's earnings? Yeah, so Snap-on, we'll do a couple things with Snap-on. So we'll look at the earnings because Snap-on had a pretty big drop on Friday too. They were down. Well, let's look actually. How much was Snap-on down? So over here on Snap stock, looks like the stock was down almost 9% on Thursday. So very big drop for this one. This was like the only stock, I think this one and maybe Visa. Maybe it was Visa or something else. I don't remember, but Snap-on was like the only stock in my portfolio that was down in the red yesterday. But as we can see, very big drop. Now it's touching almost $300 per share. And I can't help but notice that the free cash flow yield is getting pretty dang high. We've got a dividend yield that's just now slightly above the 5-year average. So Snap-on's not looking to be at a terrible valuation. But as far as the earnings, there's a couple of things that I want to show you guys actually. So I want to show you the earnings, and I also want to show you the earnings presentation because there is, I think, kind of an interesting thing to note. Okay, where is it? Was it this? Probably just this right here. So here's the high level numbers for the earnings, guys. Earnings per share was $4.51, missed by 31 cents. So a near 10% miss. And I actually think this was slightly down compared to this time last year. Revenue was slightly down as well. It missed by $60 million, which really isn't anything crazy. And was down 3.5% year over year. So some misses on the top and bottom line. It's all good. And this will show us the earnings per share year over year. So if we scroll down here, yeah, so this time last year it was 491. And then obviously this quarter it was 451. So we saw a drop, an earnings drop, earnings per share decline of about 8%. So, pretty big drop. And also prior to this, going back to the share price, guys, just like a lot of other stocks, Snap-on was getting pretty frothy in share price. It got up to over, like coming into this year, and even in parts of this year, like as late as February, as recent as February, it was over $350 per share. So this stock saw quite the run up. And kind of like UNH, any little bit of bad news was going to bring the share price down quite a bit, just because it's seen that run up. But one thing that I want to show you guys is down here at the end. It'll show us the debt and the free cash flow. So it does look like free cash flow was slightly down year over year too. Looks like we're 286 million last year, 267 million this year. So a slight decline year over year, but still, we did see an overall increase in cash, which is great in their cash position. So that's going to look good on their balance sheet. And if we see this, the cash coming into 2025, so last quarter was sitting at about 1.3 billion. Now we're just over 1.4 billion. So the cash position has gone up. Meanwhile, the total debt has more or less stayed the same. And so from a net debt standpoint, the company actually, their net debt is farther away from zero, from being positive debt now than it was this time a few months ago. So even though the revenue slightly dipped, even though the earnings per share was down 8% year over year, this is the silver lining as I see it. Number one, the company, it has a negative net debt position. So there's more cash on the debt than balance sheet. And also quarter over quarter, that cash position, or that spread, I should say, is growing. So, I'm not worried about Snap-on whatsoever. I'm actually quite happy to see it coming down, finally see it coming down in share price. And I was talking to Russ about this earlier. Well, really these last couple of days, we've been texting about Snap-on because it's one that I know is on his watch list. And, it's not a terrible price to buy it at, around $305 per share. It could definitely be worse. And you're getting a really solid company. I mean, companies have their ups and downs. That's for sure. But Snap-on, as we can see here, has been a pretty consistent grower from top to bottom. All of that's looking good. It's actually becoming more profitable over time. We see these margins increasing. We already know about the debt situation, which is looking very good. And it's a pretty crazy dividend growth stock. You're getting that, pretty much those classic dividend growth stats, 2.5% yield, near 15% 5 and 10-year dividend growth CAGR. So, all that's looking very good and very consistent. We do see that the earnings payout ratio has trickled up over the last decade quite consistently, but still it's not in a bad spot. Last year was still sub 40%. So that's nothing to be too concerned about. And overall, I think Snap-on's a very, very high quality company. Looking at the Snap score, it's got about an 8 out of 10. So above average according to this. So yes, I feel pretty good about this company. Really happy to see the cash position, or the spread between the cash and debt, continue to grow. And Snap-on's not at any risk of going bankrupt anytime soon. So they can afford to have a poor quarter here and again, now and again, I should say. Okay, guys, and we'll go through these last 4 comments. I know there's a few more questions here in the chat, but I do have to wrap it up here pretty soon. So we'll bust through these last 4 that I have starred, and we will call it a night. And with that said, I do want to apologize. I said this last week, and I'll probably say it every week from now on. I want to apologize in advance if I skip over any of your guys' comments or questions. That's never my intent. The reality is, at this point, we're consistently getting hundreds of people in this stream, which is so awesome. And with that, the more people, the more action we have in the chat, the more questions we get. And we still have a limited amount of time, and I'm only one dude. So I want to apologize if I don't get to your guys' questions or comments. It's not I'm not purposefully trying to ignore you guys or blow you off. And so I hope you never take it that way. But anyway, let's move on to this next question from Shane. Can you have a successful portfolio with just, let me actually save this. This is actually a really good question. So can you have a successful portfolio with just dividend growth stocks? Do you need high yield to feed into it a little bit, like your Realty Incomes or Main Street Capital Corporations? So first and foremost, I think it depends, Shane, how you define a successful portfolio. And there's obviously a few ways that it can be defined. We can define it in terms of the returns that it generates. You can define it in terms of if it helps you achieve your investing goals, which I can't speak for you guys, but for me, someday my goal with my portfolio is to use my cash flow, use the passive income provided by this portfolio to pay for my bills, pay my expenses. And so if someday my portfolio is able to accomplish that, I would consider it to be a successful portfolio. But along the way, at the same time, I also consider part of that success to be a portfolio that sees respectable returns. And there's going to be some lumpiness in there, obviously. It's going to have its ups and down years. But over a long period of time, I also consider, adequate returns, both in terms of share price and dividend income, the total returns. I want those to be adequate. So that's also part of the success to me. And so to answer the question, can you build a successful portfolio with just dividend growth stocks and without high yield stocks? Absolutely. Just speaking of total returns, if we're just looking at it from that point of view, 100%. Because these dividend growth stocks, okay, so let's actually take a step back here. This might be a little bit of a tangent, so I apologize. I'll try and get through it quick and not ramble too much. But when you think about what drives a stock's returns over a long period of time, over the long term, not just the short term. The short term, it could be a ton of different things. It could be news. It could just be just momentum. It could be other random noise that moves the stock's share price in any which direction, up or down. So, but from a long-term perspective, what really drives a stock's returns is the financial performance of the business. And the longer the time period we're talking about, the more that's true. And when it comes to dividend growth stocks, what does it take for a stock to consistently grow their dividend? Well, the only way that a company, I should say, can continue to grow its dividend over a long period of time is if the business itself is growing. If the revenue is growing, if the earnings per share is growing, if the free cash flow is growing, that's the only way that a company can continue to sustain its dividend and also grow it into the future. So the two go hand in hand. They really do. If a stock is able to grow its dividend over time, that means that it's also got to be financially growing. And if it's financially growing, well, then over time, that stock should continue to go up in value. It should continue to be worth more over time. And so just from a total return perspective, you can build a very successful portfolio and see really strong returns just investing in dividend growth stocks. So now on the other side, or on the other hand, if we are talking about success in terms of being able to pay your bills, then I still think the same is true. And it really just depends on two things. Number one, how much time do you have between now and when you plan to use your investments? when you plan to start pulling your dividends to pay your bills? How much time do you have? And also, how much are you investing? How, how basically how aggressive are you? How do I want to say this? How aggressive can you be in building up your portfolio and buying shares? It's those two things. It's time and money. And that's what's going to make the difference when it comes to building a successful portfolio in terms of, how likely it will be able to pay your bills down the road. If you're starting investing today and you only have 5 years until you retire, it's going to be really, really hard to build your portfolio up to the point where it's able to cover your entire lifestyle in that short period of time, especially if you're just investing in stocks like Snap-on or Visa or Lowe's, which all have like yields under 3%. It's going to be pretty hard to build up that cash flow stream in that short amount of time. So with that, you really need a lot of time on your side. But at the end of the day too, like you shouldn't just, like, that's not an excuse to just buy super high yielding stocks. Like you still shouldn't go all in on Altria Group and Blue Owl Capital Corporation and Realty Income and Main Street Capital Corporation. If you have a shorter time horizon, maybe you need to rely a bit more on those. And if you're going to go that route, please just don't go the yield max route. Just try and invest in companies whose dividends at least look stable and sustainable and hopefully should be that way for a long period of time. What was I? You see, I'm getting off on a tangent now. I'll wrap it up here. I don't know. I don't know what I was saying. I think you guys know where I was I think you guys know where I was going with that. Long story short, yeah, you can be successful just with dividend growth stocks, but personally speaking, I still like to have a balance in my portfolio. I like to have the best of all worlds. I like to have that go anywhere, do anything approach in my portfolio. And no matter how old you are, no matter how much time you have, you're going to want your income to grow. And so I do think that you need to have at least some dividend growth stocks, or at least some growth in there to make sure that your income's continuing to grow. Let's see. Okay, so this next one comes from the Lean Mean Dean Machine. Do you have any thoughts on Disney? That operation totally amazed me. What operation? That operation. Did something happen with Disney and I missed it? Doesn't look like it. I feel like we talked about Disney pretty recently. Maybe it was 2 weeks ago or 3 weeks ago in the stream, we went through Disney. We'll take a look at it again. It's down quite a bit in the last year. So far this year, it's down a lot. Free cash flow yield's not too bad. Looks like it's quite a bit above the average. Yeah, it's not too bad. The revenue growth has still been very nice. The free cash flow was kind of spotty, in these years here. Margins have they've really taken a hit. I don't know. It seems like Disney's it's on the up and up. The debt situation is definitely getting better, so I like to see that. I don't know. I think for me, Disney is still TBD. I think that there's better companies out there that you can invest in. It's not really one that I'm particularly interested in buying at this point in time. I'd rather just buy more Visa. I'd rather buy Rollins. I know they're totally different companies in different sectors. I would even rather buy Comcast. Is this in the excuse me, communication sector? Yeah, it's in communications. So I would rather buy Comcast. I would rather buy Nexstar. I'd rather buy Meta, which is also in communications. So like I said, there's just other companies that I would much sooner own than Disney. Gilbert, yeah, what's your occupation? So I did answer this at the start of the stream briefly, but believe it or not, my full-time gig is this right here. It's making YouTube videos. I put out a weekly email newsletter, and everything that goes along with that. This is my full-time job, and I've been doing this full-time for the last 2.5 years. I started doing this full-time back in October of 2022. Yeah. October 2022, like pretty much as soon as my wife and I moved to Las Vegas, that's when I went full time with this. And I really wasn't planning on doing it then, but the stars aligned, and circumstantially, I just was kind of forced into it, and it's worked out so far. And really, like at this point, I mean, I love doing this. I doing this has been one of the greatest surprises of my life. I never would have thought that I would be this interested in stocks and investing as I am, and I never thought that I would be talking about it on YouTube for a job. But I'm so fortunate. And really at this point in time, my whole goal is just to see how long I can keep this going, because I really, really love doing it. And yeah, I'll just leave it there. So yeah, this is my full-time job. And let me just say that too before we move on. Like if I can do this, guys, I don't know if any of you guys have ever considered starting a YouTube channel or getting involved in social media in some way, shape, or form. I mean, there's so many different ways to do it. It doesn't have to be YouTube. You go on Twitter, Instagram, TikTok. You could start your own blog or newsletter. There's so many different ways to slice it. And if you've ever thought of doing something like this and throwing your hat in the ring, I'd highly implore you to give it a shot and give it a try, because you never know what those things can grow into. And if I can do this stuff, then really anyone can. So, but anyway, guys, this is going to be the last question. This one's from Silverton, who says, what's your opinion on Main Street Capital Corporation? Do you think that if a trade war drags on for a long time, small businesses might go bankrupt? And from an investor's perspective, the stock price could probably go down, as how this was finishing. So at this point, I still feel fine about Main Street Capital Corporation. If a trade war drags on, then some of their underlying companies may be impacted some, but I would be surprised if it caused like widespread bankruptcies across their entire portfolio of businesses. I'd be very surprised if that was the case. Main Street tends to have pretty conservative underwriting. They've got first lien position on, I don't know the exact percentage, but over 90% of the loans that they write, something like that. So I still feel pretty good I still feel pretty good about Main Street Capital Corporation. I think what would be a greater detriment to Main Street is if interest rates came back down, because once again, I don't know the percentage of this, but a lot of the great majority of the loans that they write are floating rate loans, which means that the interest rate on them goes up and down as the funds rates go up and down. So if interest rates across the board go down, that means that business development companies like Main Street Capital Corporation will generate less interest income, which basically means they're not taking in as much money. So that would be negative for them. But at this point in time, I'm not as concerned about this other stuff. So yeah, I still love Main Street. And Blue Owl too. Like there was a period of time where Blue Owl was like, under $12.50 a share. I think I scooped up in total 14 shares, and I think as of yesterday, it's already back above 14. Things are just so crazy. Things are just so crazy right now in the stock market. Yeah, Joey, you heard about the Beatles biopic they're working on. I did see that. Excited for that. There's been this, and maybe you guys have seen it too. There's been this picture being shared around on like Instagram and stuff of this kid who took a selfie. This was probably 20 years ago when he took it. Maybe, I don't know, 20, but a long time ago. There's this picture going around of this kid who shot a selfie in Omaha, like outside of a restaurant, and he's got a selfie going. In the background are two guys sitting on a like a park bench, it looks like, and those two guys are Paul McCartney and Warren Buffett. And I just thought, man, I couldn't even imagine like being that kid in that moment. That would be so crazy, so crazy. Oh, thank you guys. I'm seeing some nice nice comments here. But we're going to wrap it up, my friends. It's almost the top of the hour. I went about 10 minutes longer than I wanted to, and I've gotta get ready for the gym. I think my wife will be home from work now any moment. So we're gonna hit the gym. Got a big leg day tonight. And then I think we're gonna grab some. I don't think we're gonna go to Chipotle. We're gonna go to this other place called Alizaba's. It's called Orizaba's here in Las Vegas, which is pretty much the same type of idea. We've never tried it, but it's supposed to be really stinking good. We keep hearing good things. So I think after the gym, we're going to go try out Orizaba's, and I'm going to get me a big burrito. So that's what's going down on this crazy Friday night. Couple things before I sign off for the night. First and foremost, I've got a subscriber portfolio review video coming out first thing tomorrow morning. We've got 3 great looking portfolios on deck that will be reviewed. So that's going to be going out first thing tomorrow morning. Along with that, next week, I will be working on a video that is unlike any other video I've ever done here on this channel. I don't know if it will be good. I don't know if it will be interesting. We'll see what happens, and I'll give you the gist of it now. This video is going to be there's going to be kind of a lot going on with it. So first and foremost, this video will be, I'll reveal the new position that I added to my portfolio, the new stock that I just picked up this week. And real quick, do you guys have any guesses as to which stock that is? If you know, which if you're following me on Blossom, you already know which stock this is. If you already know, please don't spoil it. But if you don't know and have a guess, let me know in the chat which stock you think I added to my portfolio. I'm curious to see how many of you guys get it. I know some of you will. But so in that video, which will probably go out, I don't know, sometime probably later next week, I'm going to reveal the new position in my portfolio. But also my wife and I are going to be, I have some other actually very, very, very big news, not related to my portfolio, some big life news that I'm going to be sharing with you guys in that video. And then also, in addition to those 2 things, my wife and I are going to be celebrating our 1-year anniversary next week, 1-year wedding anniversary. And we're going to do a little staycation on the Strip. And so I thought it would be fun to take you guys along with that. And for the first time ever on this channel, and I used to do this stuff back in the day, I haven't done it for years, but for the first time ever on this channel, I'm going to be doing a little basically I'm going to take you guys with me. We're going to be doing a little vlogging. I've got my point and shoot vlog camera here that I'll be showing. So I'm going to take you guys along and show you just kind of like a little day in the life of a dividend investor over here. And I might start doing those videos once a month or so if it's interesting to you guys. If it's not, then I may not, but I'm pretty excited about making it. I think it'll be just something different, and it'll be fun to put out a video that's just, every single video on my channel has been right here, talking head. And so it'll be fun to do something different and show you guys some more of the behind the scenes stuff. So, yeah, some good guesses here in the chat. I see some Target. I see Rollins. I see Zoetis. All really good guesses. Chris says TSLY there. Man, I told you not to spoil it. Gertej says Meta. Really, really good guesses, guys. Really good guesses. So anyway, all that's going to be going on in that video next week. I'm excited to make it, and we'll see how it goes. But that's all I got for you guys. Otherwise, thank you so much for hanging out with me this last hour and some change. Another really fun happy hour. And I hope you all have a fantastic weekend, and we'll see what Monday brings. Like I said, I'm picturing some red, but could be wrong. So anyway, yeah, we'll leave it there. You guys have a great night, have a great weekend, and I'll see you in the next one.